Right, we will. We've got a good number of participants in the room, so we will start the session. So thank you everyone who could join us today. It's great to have you all here. We've had a brilliant sign up for the event, and I know that that's partly because Neil's promised to give us a nice song at the beginning of the session.
Oh God, not true.
No, it's just a particularly relevant topic, and obviously a very interesting topic for founders and CFOs of startups and scale-ups. So really excited to talk about this topic on this session. It was great to meet Neil at the Web Summit, and then we got talking, and it just made sense to kind of share this event with the wider audience. So essentially, a number of people on the call may not know who either of us are. So quick intros, and then we'll get straight into the session. So who is Zanda? So essentially, Zanda support founders, VCs to scale their startups. So essentially, we work with seed through to Series D businesses as they look for primarily a CFO, finance director, VP of finance. But also after working with founders or VCs, we can support across a range of senior leadership and board hires. We've been working with a brilliant number of clients over the last 2 or 3 years. And what we try and do, I guess, from a collaborative network perspective is bring events that are relevant to our audience. And this is a great example of that. We are very much more conversational as a search firm. So if you have intros that you would like to get from us, or kind of conversations that you'd like to have around, team structures, salary benchmarking, then feel free to reach out. We do a couple of regular monthly sessions around choosing the right finance leader. So whether you should go for an FC or a CFO. And also we do one on building a board of directors that investors love. So they're both kind of regular sessions. But Neil's the guest today. So Neil, do you mind just giving us an overview of your background personally?
Sure. Andrew, thanks very much for having me. And hello, everyone. Hope you're having a good day. So my name is Neil Shah. I head business development for the tech sector at London Stock Exchange. For my sins, I was an investment banker for the last 15 years. I worked at a number of European banks, and most recently Stifel, which is a large US bank, focused also on the tech sector, doing M&A, helping European clients make acquisitions and sell their businesses, typically to American buyers. Also worked on a number of IPOs and secondary fundraisers, not only in London, but other markets like New York and Frankfurt and Sydney as well. And I am father of 2 boys, live with my wife in Gants Hill in East London. I'm a Liverpool fan for my sins, very happy the Porto result last night. And I hope they continue to give Man U and other teams a hard time.
Neil, that wasn't covered on our first conversation. I'm a United fan, so thank you for that. That's very kind.
My pleasure.
Thank you very much. I feel that, I've just had a few messages from the attendees questioning my vetting of the guests, because I know there's a few on here that are United fans. So we'll talk about that another time. But thank you for the intro. Why are we running this session? So obviously there is a common theme in the market at the moment of a traditional route of VC, Series A, Series B, Series C, whether that's a trade exit, whether that's a buy and build play to then do a PE exit. And actually from talking with Neil and also always being aware of the IPO route, personally, I felt like it's not as visibly aware to early stage founders and kind of mid-market stage founders and the benefits of it. So it's clearly not for everyone, but actually it's for a lot more people than perhaps are currently kind of are venturing down that path. So the pure aim of this session is just to educate people on the IPO route and the benefits that can provide to startups and scale-ups, and some of the parameters that people need to consider pre and post IPO. So I hope you feel comfortable with those things, Neil, and that you can be our expert for today.
I'll certainly try. And if there's any questions I can't answer, I'm sure we can get these questions answered for you and the guests.
Thanks, Neil. So there will be a presentation that we will share at the end of the session, a full deck of the presentation. It's reasonably detailed. So what we're going to do today is dig into relevant slides that link to some of the questions that I've had in advance from attendees and also that I thought would be of interest. So we're trying to make it flow as much as we can. And obviously that will be slide and conversation related, but we'll share those slides with you subsequently. So Neil, just, I guess to start us off, what is the IPO market like right now? And what are you seeing?
Sure, it's really, really hot, and I'm just hoping to get this slide up so I can talk you guys through that. So just give me 1 second. Here goes.
I will let you know when it shows.
Right.
Yeah, it's showing. Thanks, Neil.
Super. So there we go. I don't think we've seen a market as busy as this since about 2014. We've had over 100 IPOs in the year to date, and a number of these have been in the tech sector, 34% of all the IPOs, but also seeing a number of IPOs in financials in the healthcare sector. What more generally, so about 15 billion pounds has been raised just for IPOs this year. And to put this into context, we had about 50 billion raised in total last year, but a lot of that was follow-on fundraisers. London's actually been the most active stock market outside of the US and Hong Kong this year, which sort of matches what we see in the private world, where we've created about 100 unicorns since 1990, again, the most outside the US and China. So we've added about 31 billion pounds of market cap in terms of tech and consumer internet to the indices, and that's great. And hopefully we can see a few more of these. IPOs has been a place where investors want to be because, frankly, they've delivered a return in excess of the FTSE 100. And this is where a lot of the excitement's been. And one of the things about London and how we compare to other markets is that it's a really deep market. It's not just about IPOs, but once you are listed, its ability to come back. Just to throw an example out there, if you take ASOS, they joined the market, I think in 2000, with a market cap of about 12 million pounds. They've raised about 9 times since then. Not a huge number, but probably another 900 million or so from public investors, and that's enabled them to obviously grow organically, but also do acquisitions. And we've got other companies like Keyword Studios that have been able to do 50 odd acquisitions once being on market. So I think the beauty of being a publicly listed business is that when you want to raise that follow-on capital, it's easy to do so.
And what are some of the reasons do you think that's helping with the resurgence versus the last 5 or 6 years? What's happened in the last 5 or 6 years which just developed this growth?
Sure. So we had this massive overhang of Brexit and what it means, which just made it very hard to make any decisions, right? That sorry, I think I've messed up my slide order here. Andrew, amateur, clearly. So look, what's driving momentum? It's this recovery from Brexit and COVID. Companies' needs, right? Ultimately, why would you IPO? It's probably because you might need some funding, or that borrowed cash from VCs needs to be returned, and you need to find some more permanent capital, and that's where public investors come in. It's in the shareholders' needs. Maybe you want some liquidity because you've never to take any cash out of the business. Equity markets are really buoyant as well, and compared to 3 years ago, where perhaps public market valuations weren't as attractive as a trade sale or a private equity exit. Today, I think in more cases than not, that public option looks more attractive, and we see that particularly in certain subsectors of tech. If you take video games or marketplaces, for example, or even tech-enabled services, I think private equity in particular would find it pretty hard to compete with what fund managers are willing to pay for some of these businesses.
And in terms of, obviously there's been some publicity around the different and recent law changes that are either in force or coming into force. Are any of those in force already? And do you mind just, in layman terms, talking us through those recent law changes?
Yeah, certainly. So there's a lot you can do in London today. So if you want dual class shares, for example, that's seen a lot of press, the Hut Group, Deliveroo, Wise, Oxford Nanopore, were all able to have a second line of stock for their founders. This has been around for a very long time. If you take Schroders, one of our biggest asset managers, the family that controls Schroders have a second line of stock. Martin Sorrell, created S4 Capital, has a founder share. So these things aren't new. Also, another change that has been talked about is having lower free floats. Historically, to get onto the premium segment of the main market in London, you need to sell 25% of your company. And there are ways and means to come to market with a lower percentage, be that on AIM or a high growth segment, which is a ramp onto the premium segment. So there are ways. What we're trying to do, however, is make London more attractive to founders and hopefully build the most founder-friendly exchange. So the way this started was Lord Hill announced a review in November last year. We and other market participants supplied evidence in January. This review was published in March. This is a sort of once in a 30-year change to the rule book, and quite rare, but the speed at which these changes have been implemented has been fascinating. Rishi Sunak issued a response in April. The FCA consulted on SPACs. So many of you will be familiar that there's probably been 500-600 SPACs that are priced in the States. We haven't seen the same level of activity here because of regulation, which I'll come on to. And what we're trying to do is allow anyone who wants to create a SPAC in London to do so. Fortunately, that change has been now implemented, and we're about to see our first SPAC under these new rules. So dual class shares, firstly, we want to permit those on the premium segment of the stock market. The standard segment, so there's multiple segments in London. You've got the premium segment, the standard segment, the high growth segment, the specialist fund segment. Historically, this has provided a lot of flexibility for different purposes, but creates a lot of complexity. And we often question, why would a company want to go to the standard segment if you've got a premium segment? So I think that probably could do for a rebrand that's well overdue. We've touched on this point about free float, but if you are Deliveroo, should you have to place 1.5 billion pounds of stock to justify liquidity, or is a small amount going to make sense? And I think bringing that percentage down from 25 makes a lot of sense. So it's another part of the Hill review that we've been supportive of. SPACs we've touched on. So what the rule change that's just gone through has meant is that the acquirer's shares no longer get suspended when they announce an acquisition. So our rules are very closely aligned with what you have in the States, and this is why you're going to start seeing more SPACs. I don't think we'll see hundreds of SPACs here in the same way, because we've got a market that works pretty well. We have a lot of price discovery along the way. It's open to younger companies. I think some of the companies going public in the States have done so through SPACs, because that traditional route was prevented from them. We're also looking at prospectuses and looking at ways in which we can facilitate better access for retail investors. I know this is an area that you're quite passionate on, Andrew, as are we. We think it's a fair thing for companies to do, but also, if you are on the market and you've got 30 fund managers holding your shares, if they like the business, they're probably not going to trade it very much. And so that sort of day-to-day liquidity really comes from retail. And there's some changes being implemented to make that process easier. in terms of the number of days an offer needs to be open for, to make it easier for the company, for the banks, and for retail shareholders to participate. And there's a few other things, forward-looking statements, for example, being able to allow companies to put out forecasts in their prospectuses, and looking at the liability regime associated with that, allowing retail shareholders to participate in follow-on transactions, looking at historical financial information. Tech businesses grow rapidly, quickly, and if they're making acquisitions, sometimes the business it may have changed drastically over the last 3 years, and we don't want to prevent businesses from listing if that's the case. So these 12 or so points are the sort of key points of the Hill review, and what that's leading to is various sub-reviews. But the good news is that hopefully the outcome of all these processes results in some hard rule changes before the end of the year, if not early next year, which hopefully will mean more companies can come to market. But I think we're already seeing the benefit of that, because I think companies, and hopefully the audience will agree, is just seeing a willingness from all the participants and government in particular to get really behind entrepreneurship and promoting the stock market and removing these cliff edges between different types of funding.
Say, I was a Series B, marketplace, founder, or AI founder, and I wanted to do a buy and build play, or also exit a proportion of the shares. Obviously founders spend a lot of blood, sweat and tears to get their business to a certain ARR, certain number of heads, but they obviously have all of the equity, or a big stake of the equity, and they may want to take some of that off the table for their own lives, their family lives, and then still keep some shares in there. Does this, if they were looking to do a listing 2 years ago versus next year, what would that mean from their flexibility around their ownership of share capital and their rights to be able to run their business?
Yeah, so I don't think a lot has changed in that perspective. If you look at the companies that have gone for dual class shares, it tends to be the larger unicorns and decacorns, which lend themselves to these situations. More often than not, Andrew, we find founders that particularly have a large stake in the business realize that actually their rights are protected, and dual class shares creates another barrier for some fund managers to get comfortable with, right? That they're used to one share, one vote in the UK. If founders are going to have special rights, you're going to lose some people on that journey, because it's not going to be for everyone's cup of tea. That is changing, but you see the same in the States, right? There are some fund managers, BlackRock, for example, have come out publicly to say, if there are dual class shares, we want to see a sunset clause. And the changes proposed by the Hill Review are designed to land in a place which hopefully creates a win-win for investors and companies, where these rights aren't carte blanche, but they're a way to help founders get onto the market slightly more easily, and get comfortable with that new environment, and for investors to rest assured that in 3 years these rights will disappear, and they'll just become ordinary shares. On the point of secondary, I guess what we've seen in the last 3 years is just greater demand for IPOs, and fund managers are disconcerting as to whether companies are placing primary or secondary shares. They're just a little bit more open to seeing good companies, and so what we've seen in a lot of deals is vast amounts of secondary being placed. If you take Moonpig, for example, I think 4% of their capital raise was primary, the rest was secondary, for the private equity fund Exponent. Similarly with Auction Technology Group, they raised about 600 million from memory. I think half of that was primaries, the other half secondary. That's something that you can't do in the States. Investors just look at you funny, but in the UK, perfectly possible. And so the ability to take cash off the table is something you can definitely do here.
And just touching on Auction Technology Group, because obviously a business that both of us know well. Just talk us through why they listed and how that benefited them.
Sure. Um, Auction Technology Group were looking at an IPO pre-COVID. See that when the pandemic hit, I think created some uncertainty around public markets and the accessibility there. They also had an acquisition that they wanted to do. So the company was backed by ECI partners at the time. Jean-Paul and team were able to find TA associates to help fund their acquisition of Proxibid to make ATG a much bigger business. And they decided to come back to market in February this year. And it's been one of our best performers, Andrew. So I think they're up about 130% in terms of their share price. They've been able to do a follow-on fundraise where TA have been able to take their cash out. They've been able to raise some additional capital for acquisitions. And they've been able to scale that business. And that's a story that we see quite often. So just touching on something is, why would you think about going public, right? Firstly, is to raise that permanent capital. Secondly, to improve the identity and the credibility of your business. That's something that CEOs such as Peter at Trustpilot have highlighted, that is just elevating the brand. Acquisition currency. So LSE shares have been used in, I think, over 60 countries worldwide. It helps you recruit staff and retain them, create share plans. And it ought to be the most natural and easy path, right? Because you're not changing your business. You're not trying to build something that a particular buyer wants. And it's really hard to second guess, what a buyer may want. But, just building a business for IPO ought to be easier. For the management team, you stay independent, you create wealth, you get to realize that wealth. It provides a tool to motivate staff, and what your shares are going to be worth. You can create new share plans for new employees joining the business. And then if there are VCs and private equity, or what this investment's worth, there's a market price for that. You can realize that value at IPO, but also afterwards, and there's a liquid market for the shares. So it's really creating this permanent foundation for companies, which you don't have if you're dealing with GPs with a 10-year fund.
From a timescale perspective, how far out should how long should the process typically take? I appreciate there's big variables, and I guess therefore you can answer with what's the quickest feasible and what's the longest, but what needs to be done in advance, do you think?
Sure. So we see companies of all stages, right? Series A, B, through to Series H. And in terms of stuff that you want to be thinking about ahead of time, is lots of preparation is key. You want to simplify the story as much as you can. Think about the structure today and the tax setup. Accounting work stream is going to be the longest straw in the tent, and any work that you can do in advance to identify where the skeletons are, anything you can do to clean those up, the better. If you're trying to tell a growth story, but your financials and your KPIs don't support that, that becomes quite hard. And that can often determine timing, right? Are there key milestones that you need to hit to make that story more compelling? This, like any transaction, is hard work. It's going to involve a lot of resource, and there's ways you can make it easier for yourselves. We meet so many CEOs and CFOs who are doing this for the first time. It's not hard, it's just time consuming. And there are ways and means to make that process easier. Some of the feedback I've had from guys like Andy McKinnon at Moonpig is the best thing they did was to hire Joe Cave as an IPO manager that made that process seamless. Peter Glover worked on Deliveroo and Wise's IPO, and I heard similar feedback on what he's able to do there. There's a lot of, I'm sure you do this, Andrew, at Zanda, is help build out the finance teams with guys and girls who might have been through some of these processes before, to help CFOs. So, the lack of public company experience shouldn't be a hindrance to companies on this journey.
And if you had, for example, a Series C business, Series D business, and they've got a CFO, they've got maybe previous experience of IR, or kind of investment banking experience of that nature, and a good structure, and the story is growth, and it's telling growth, and it's actually quite a straightforward story. Is it feasible to turn this around in 3 months, or is this 6 months? Is it 2 months? What do you think is kind of feasible?
Yeah. 3 months is definitely possible. I guess the long straw in the tent is where the numbers are, right? That do you need to convert into IFRS? What's your year end? And when are you looking to go? Because numbers do have a shelf life, especially if you're looking to raise capital from the States. I think there's a rule pertaining to 135 days before the last audit, and that often dictates when you press that button. But I think the best thing that any company on that IPO journey can do is ask their auditors, often play the second role of reporting accountants, to conduct a readiness exercise to find out what they need to do to get ready for that IPO. The fastest we've seen an IPO done where companies have got audited financials, they may have not picked their board yet, is 10.5 weeks on AIM. So you can move rapidly. And secondary fundraise is even faster, right? Once you're on market, you can go and tap fund managers for additional growth capital in as little as 2.5 weeks. You'd probably say 4 weeks, and in terms of the IPO, I would advise companies to plan on 6 to 9 months, but it's possible to work faster.
Which for the PE space is quicker than most of their timeframes, I assume.
Yeah. And why is that? It's because you've got research analysts that understand the business. There's research in the market. Fund managers are already invested, and the type of diligence they do, Andrew, because they're looking at hundreds, if not thousands, of companies, is going to be higher level. They're not going to ask you to analyze churn 6 ways. They'll take your and the analyst's word for that and hold you against those expectations. And
in terms of your role and the rest of your team's role, how much help? Obviously there's only so much you can do, right? In terms of preparing the business, because you're not in that business. But what is your role in this process, and your rest of your team? How is it structured, and how do you help?
Sure. So there's 20 of us in the primary markets team at London Stock Exchange. I've got 5 colleagues in the UK, and the rest of the team are spread around the globe. And what we're trying to do is make sure that companies and boards and shareholders are aware that London Stock Exchange is open for business, the type of profiles companies need to have, sharing and raising awareness of what's going on. And secondly, connecting companies with advisors that can help get jobs done. So that might be bankers, might be financial PR firms. PR, as we've probably seen in the press, is hugely important. Same with accountants and other advisor, the 2 sets of lawyers that you need on a deal. We're also sometimes asked to help fill out the board, and there's no shortage of experienced public company execs looking to help new startups make that transition to public markets. So what we're doing, Andrew, is really providing a sounding board. And this isn't just for that IPO. It's once companies are listed as well. It's we'll come on to life as a public company. It comes with good days and slightly more challenging days, but rest assured that there's help at hand.
And on that point, kind of tips and things to avoid post IPO. You can just talk us through those.
Sure. So we've actually got a little page on this. It's impossible not to talk about shares, right? Your shares are going to go up and down. There's very little that you can do to control the share price at times, but there are some things that can help influence it, right? So what drives the share price is going to be execution first and foremost, right? So if you're growing, if you're expanding margins, perhaps you're reducing the burn, you're moving into profitability, because eventually you'd want to become profitable. That's all helpful. But first and foremost, it's really that top line growth. People want to see that you're executing on your strategy and taking share. Having simple, clear and transparent communications is key. Being able to tell that elevator pitch. Think about these fund managers that you might meet twice a year. They're going to be passive versus the active investors that you might have met, being a privately held company with a few VCs around the table where people have board seats. Typically, fund managers don't have those board seats, and they're seeing you twice a year unless there's a problem. And just being able to distill those messages into clear statements is hugely helpful. Expectations management, easier said than done. If you are operating the States, you'll be used to shooting for the moon, and if you get 90% of the way there, people will give you credit. I think London is slightly different. That if you do miss those expectations, it can be damaging, and it's hard to recover the trust that you may have built up along the way. So much better to underpromise and over-deliver, or just simply deliver and try and do that consistently. All easier said than done. And lastly, I'd say good behavior, right? There's you're going to have good advisors and board members around the table, and make sure you have the right team around you. Listen to that advice, challenge it if you must, but let them help you. Don't have a rant with a journalist on Twitter when you don't need to. That sort of thing. And lastly, don't look at your share price the whole time. You're not alone in this journey. Make sure you've got a good team around you. CEO, CFO, the board. Make sure that those board members are useful. It's helpful to have someone with public company experience that some of the investors might know, but hopefully there's board members that can be useful to the business and help drive that execution. Find good advisors. There's no shortage of good advisors in London, and you're not going to agree with their advice the whole time. And do challenge market norms. But often that advice is being given for good reason. So it's important to listen to it, and talk to your peers. Being a public company CEO or CFO, doesn't need to feel lonely, because there's 2,000 or so others on our markets, and people are very keen to help each other on journeys, share notes, compare experiences, help you solve challenges. And a lot of these relationships are fluid. That the banks that you use to IPO may not be the banks that you're using in 3 years' time to make a major acquisition in the States. It's helpful to make friends along the way. And
sorry, I'm interrupting you.
No worries. Look, I'll let people look at some of this, but we've recorded a number of podcasts where we've interviewed CEOs recently. So you'll see some things that I've picked out here.
I love the top one.
Yeah, that's awesome. So Peter's exact words, I think, when we interviewed him was, look, at the point of IPO, you're going to be game over, done. Just book a 4-week holiday. And if you've got a good business, it should be able to tick itself over. And I think that's great advice, because an IPO isn't hard. It's just intense like any other transaction. You probably will need a break before you start on that journey. It can get emotional, but try and remove emotions from it. It's not hard, as Sarah Murray says. She was our third female tech entrepreneur to list a business this year, which is fantastic. We've seen a number of minorities bring their businesses to market as well. London's a really open place, Andrew, and we see companies of all ilks, all sizes, from all over the globe. That this is really an option worth taking a closer look at. Historically, I don't think we've seen that, because partly because of confirmation bias, right? That boards and management teams are just used to selling their businesses, and that's been the sort of default route. Or if you have a USP or growth equity firm in your cap structure, perhaps their experience has just been US IPOs. But this year, take TA Associates bringing Auction Technology Group and then Eurowag to market. I think things are changing. Most VC and PE firms have got recent experience, and some have even floated themselves, like Draper Esprit and Malton Ventures or Bridgepoint. So that's becoming slightly easier.
And actually, some of the questions have come in are kind of questions I was going to ask anyway. But why the UK over Germany or the Nasdaq or China? Yeah, what are the key differences?
Sure. So I think that the first point, right, is we often get compared to the States. Ido Ehrlichman, CEO of Cape Technologies, said that if you want to build a global business, the options really, when it comes to going public today, is probably London or New York or NASDAQ. China remains a very domestically focused market that I don't think I've seen any, or at least many international businesses list there. And for, let's say, a British business, global business, even Trustpilot, London just lends itself as a more neutral home. You don't need to be a centaurn to go public in London, for starters. If you look at the S&P 500, I think the bottom end is McDonald's, Wells Fargo, Honeywell, Qualcomm. These are $150 billion businesses. No one's going to care about a Wise or a Darktrace or a Deliveroo in the States. I'm sorry to be the messenger, but it's true. And if you are a decacorn, you could probably qualify for the FTSE 100. I mean, as Darktrace has illustrated, they're not even at that point yet. You get so many benefits in London: deep market, local and international funds. There's no discount here. US funds probably make up 40-50% of the share registers of companies, and we can support direct listings as we did for Wise. We've got our first SPAC coming to market. We've talked about dual class shares, and you could do all this without some of the headaches, right? That if you really want to, you can report quarterly. All my former clients, CentralNick does this, and look, they've got the visibility that allows it. But perhaps you're a hardware business or a business where you don't have recurring revenues, and it's just harder to do. Why put yourself through that headache? There's no Sarbanes-Oxley to deal with here, and there's just a lower cost associated with significantly lower litigation risk. I think we've had 3 class action lawsuits in the last 10 years compared to hundreds each year. And obviously that factors into what legal fees are in the States, what D&O insurance is as well. 700 of our 2,000 companies are headquartered overseas. Tech's growing. Yeah, very, very diverse market. And one thing we're trying to do is allow companies to offer shares to their customers, their employees, their partners, retail investors. So we, together with Malton Ventures and a few other VCs, took a stake in Primary Bid that has a piece of technology, essentially an app that allows people to participate in IPO should that company and the banks choose. It just makes it really easy for people to play in IPOs, and we're seeing this develop in the States. We touched on that relevance point, but if you look at the largest 10 companies in the UK, CASP in tech and consumer internet, you've got Kaspi, Just Eat, Ocado, and you compare that to the States, it's quite phenomenal. So hopefully this is reason enough to think about London versus the States, where I think it's very hard to stay relevant.
Well, isn't there something crazy during the COVID period where the top 2 in the States were the equivalent of the whole of the FTSE 100? I can't quite recall, but it was a pretty remarkable stat.
Yeah, it's a huge mark and has always been so. In terms of valuations, if you look across Europe, companies that are executing well in their various subsectors, there's no reason why those European businesses can't achieve a better valuation than their direct peers. So I think this notion of higher valuations in the States is a bit of an urban myth, and when you start to compare apples for apples, you often find that better company gets a better valuation. London's a deeper market than many other European markets as well. 217 odd tech and consumer internet companies here. Market caps have been going up. So the mean market cap is probably closer to $1 billion now. Lots of routes to go onto market, and a big spread of companies. Perhaps you won't find the perfect comp if you're, let's say, an infrastructure software business. There's probably 2 others on the market here versus 10 in the States. But when analysts are looking at these businesses, they're not just looking at peers in the UK or Europe. They are looking across the pond to find the most comparable businesses. And given the fact that investors are global, they're often looking overseas. We've seen a couple of businesses come over from the States this year, TinyBuild and Devolver in the gaming sector. I think gaming is an area where London is probably the world's leading market, where companies can achieve really robust valuations, because this is a sector where investors have made money and they really get it. And I think most banks have a gaming analyst today. Marketplace is the same. Cybersecurity, lots of depth. FinTech, we've had 5 or 6 IPOs. So lots going on.
And just in terms of European competitors, so Frankfurt and others, have they stolen some kind of market share from London during the Brexit period, or has that been reasonably stable?
Yeah, this was the fear coming into this role, that out of Brexit we're going to start losing companies. And I have to say it's probably been the reverse. So we've had Glantis from Ireland, Trustpilot from Denmark, a number of companies from Eastern Europe, including Eurowag. And I think it just boils down to that depth of market here, and the fact that we're open to companies of all sizes, right? So we've had founder managed businesses, VC and PE backed businesses, international businesses, loss-making businesses. It's a really diverse pool of companies, and some of our companies like Craneware don't even make any revenues in the UK. They all generate overseas. So it's great to be able to highlight some of these examples to companies.
That's crazy that they've got no revenues at all in the UK.
Yeah.
We are coming towards the end. Have I missed anything on the slide deck that you wanted to show, Neil?
I'm just thinking that there's probably one slide which is just comparing us with the US sort of.
Yeah, that's what I was thinking. Actually, this one. Yeah.
Yeah. So we touched on half-yearly reporting here, that liability regime where CEOs and CFOs are not going to go to jail unless they've done something horrendous. But it is a significant risk in the States. Index inclusion, really possible here. We've highlighted Darktrace, but Trustpilot, Moonpig, Molten Ventures have all gone into the FTSE 250. We touched on litigation risk, fees as well. Look, this is just a really open market where we see a lot of international investors, international companies. The companies are really diverse, and I encourage everyone to have a look at it. It's really easy to explore an IPO, Andrew. So just like going to see some VCs presenting a deck, you can do the same with public company investors here, and get a sense as to whether there's going to be any appetite for a deal or not.
Yeah, that's great. Thanks, Neil. I'm just going to jump into the Q&A because there's quite a few questions that have come up. It might be worth just hovering on that Q&A bar if you can see it as well. But yes, I'm just going to start with Rav. So any idea of the average age of the tech companies when they've IPO'd with you?
Yeah, I looked at this stat recently. So this year, I think the mean is about 17 years.
Okay.
The oldest is probably about 50 years in the case of Auction Technology Group. I think Microlise was about that old as well. But on average, about 17 years. The youngest has probably been Alphaway, which is about 4 years old.
Wow, 4 years.
Yeah.
Am I right that one of the limitations of a SPAC is the IPO can't be used to raise funds for the startup?
No, I don't think so. That you're raising funds to buy a company. It could be a startup, and those funds could be used to invest in the startup. I guess what we've seen with SPACs, particularly in the States, right? If you look at Kazoo and Babylon and Wejo that have listed there, it's just the high level of redemptions, right? That you think money's in the bank, but actually you end up doing an IPO in itself because you're having to go around and replace the money that ought to have been there for that acquisition. So these transactions, which were initially promised to be less risky because you've got money already lined up for the D-SPAC, doesn't always transpire to be there. And so I think that's just leveled the playing field. Why have we seen so many SPACs in the States? It's because the market wasn't open to younger companies, but also when companies go public in the States, you don't have the same process as the UK. So in the UK, when you're doing a deal, you might see a fund manager 2, 3, 4 times ahead of an IPO. A research analyst might publish a research note that's 80 pages long. People know what they're buying. In the States, fund managers are almost betting blind. And that's why you often see deals that are underpriced. And hence on that first day of trading, they go up 80, 90%. VCs like Bill Gurley get very, very upset and say the IPO process is broken. Go and do a SPAC, go and do a direct listing, and hence why we've seen so many of those, but not so many here.
Neil, quite a long question here from Michael. Has the percentage of algorithmic trading increased drastically as part of the Brexit risk mitigation? How do these trading algorithms treat IPOs without the lack of trading history and high frequency trading scrambling the real valuations in early phase?
Great question.
Big question.
I'm afraid I don't know the answer to that, but I'd probably say that given the lack of trading history, I suspect there's going to be minimal participation in IPOs as a result of some of those algos, but we can certainly take that one offline.
Do you know when US SOX is coming? UK SOX.
UK
we know what you SOX.
Yeah. So look, this is up for debate at the moment. There is a SOX light that's been proposed. Not everyone is an advocate of this for obvious reasons. So I don't think there's a definitive date in mind, but I suspect, if anything, it's several years out.
Okay, cool. There's a comment here from Nadeem, and it probably would be helpful if you read it as well, because it's quite long, but it's interesting because it's obviously in the gaming space that we talked about before. So I'm the co-founder of an automated esport platform. There are only 2 of us in the world, and we are the only one with the official license from the game developer to operate. Whilst the others are 9 months ahead, they have raised 17 million in funding valued at 60 million with 1 million customers. We are only 3 months into the journey, but raising funds is missing part to execute on our plan. Welcome any thoughts or ideas. Another one for offline potentially.
Sure. I mean, what I would say to Nadeem is, go and speak to advisors. Many are able to raise funds privately as well as publicly, and could probably give you a sense of what the art of the possible is on either route, and compare and contrast what makes sense. And one thing we're seeing increasingly is that dual track. Because ultimately we want the right companies on our market. We want you to be happy with that listing. Sometimes you can come to market too early, and I think advisors are best placed to help you with that.
And obviously we've touched on sounding boards from your perspective and from LSEG perspective, but also advisors, which some you may give free advice, most may not. But are there any recommendations from a book perspective or podcast or anything for startup founders to learn more about IPO listings?
Absolutely. So we've got our own podcast called the London Tech IPO podcast. Please tune into that.
A good segue to a plug, wasn't it?
have a look at my LinkedIn and Twitter as well. What we're trying to do is collate any nuggets of good advice and put them out there. And that we are really happy to talk to anyone who we might be able to help. And it doesn't matter, you're thinking about an IPO next year or in 10 years. We want to build a better ecosystem in the UK.
Brilliant. Well, look, Neil, I think that is, unless there's any questions that come into the box in the next kind of minute or two, I just want to thank you for your time. It was a really good session. Great to hear kind of the updates and some tips on pre and post and some of the averages of coming to the UK and London. So is there anything else you wanted to share with? We'll obviously share the slides and we can keep you in contact with relevant people if and when there's a kind of more individual question. But is there anything you wanted to close with?
Andrew, thanks very much for connecting me with this fantastic group of people. I'll share an extended set of slides with you. Feel free to pass those around. And again, if I can help anyone, don't hesitate to get in touch.
Yeah, thank you again, Neil. And thanks everyone for joining. Enjoy the rest of your week and see you again soon. Cheers, guys.
Thanks, everyone. Bye.
Take care.